Welcome to Manifested Publishers.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I am a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are discussing about business and data analytics, question 21, which came in the December 2022 exam. So question 21, we had answered it in our previous lesson, and just to recap what we discussed or what we solved, you are provided with the following extracts of the statement of profit and loss for Sepetuka Limited. So you can see the statement of profit and loss from years 2019 through to 2022 were provided. You are required to calculate and interpret the following ratios: the annual revenue growth rates for years 2020, 2021 and 2022, the 3 years cumulative growth average growth rate (CAGR) for year 2022, the effective tax rate for the period 2019 to 2022. Now, in part B, we were told to assume the following for Sepetuka Limited. The revenue growth rates are forecast under 3 scenarios, namely the base case, the optimistic case, and the pessimistic case right there. The base case growth rate for the first year forecast is the 2022 CAGR. This is expected to reduce by 2% annually until the last year, the forecast subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. Gross profit margin for the first year of the forecast is the 3-year average for the period from year 2020 to 2022. This is expected to reduce by 2% annually until the last year, forecast subject to a minimum of 50%. Operating expense ratios are modeled as the 3-year averages for the period from 2020 to 2022. These are assumed to remain constant over the forecast period. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for the period 2020 to 2022. Finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate in year 2022 over the forecast period. Number 6, income tax expense is calculated as a historical effective tax rate. So let's move on over to Excel worksheet. And this was question 21, that solution that we had already solved. You can see right down over here, we've put question 21A. The average revenue growth rates for years 2020, 2021, and 2022 are displayed to you there. The CAGR is 21%. The effective tax rate for period 2019 to 2022 have been displayed to you on your screen. Now we move over to question 21B. Click that tab and you can see this on the right of your screen. I have the statement of profit and loss extract as the way it was given in the question. And you are required in part B, go down over here, to prepare 5-year forecast statements of profit and loss for Sepetuka Limited from year 2023 to year 2027. So you can see that I have got, I've replicated this extract of profit and loss, which is on the left of your screen, right over here on the right of your screen, right up to there. And what we need to do is that because you're creating forecasts for the years, I can come here and create or distinguish that these are forecasts. They are not actual values there. So what I can do is that a true analyst or accountant is supposed to put F or put E just after the year that you're trying to estimate or forecast on, F, so on and so forth, like that. 2026. Then we can move on to the next one, 2027 there, F, like that. So as we move along down and populating these cells, we are going to make the relevant adjustments. And you can see we start off with the first adjustment, first information we've been given. So I'll highlight it so that we can distinguish what we've solved and what we haven't solved there. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year forecast is the 2022 CAGR. And we have already worked out the 2022 CAGR in this tab part A above. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case. So we are first of all beginning with the base case right over here. So we can just try and distinguish it over here, and then the optimistic case and the pessimistic case would be worked just down below over here. So let's begin by populating the revenues or the sales. We are informed that the growth rates are forecast under 3 scenarios, namely base, optimistic, pessimistic case. The base case growth rate for the first year forecast is the 2022 CAGR. So plus, we pick that revenue for 2022 multiplied by, open the brackets, 1 plus G. What is the growth rate? The CAGR, which you are going to pick from this tab right over here. So we just go there and pick the compound annual growth rate there, and we close the bracket there like that. Enter. And it picks the value of the forecasted sales. Now we are accountants, analysts. We need to ensure that there is consistency in terms of the commas. So we come over there and click this one over here. However, we are sophisticated enough to know that we just click Alt H. You can see where K is, represents that comma over there. So we press K. And this whole subsection over here will be populated with commas there, the similar format there. So how about 2024? So this is expected, you can see right on the bottom, on the left of your screen right here. This is expected to reduce by 2% annually until the last year of the forecast. We just pick plus that one over there, and then times, open the brackets, we pick 1 plus 1 plus. So you can take this value, open the brackets, 21% minus 2% gives us 19%. So 19% like that, and we close the brackets like that. 137 that. Then go over there plus this value. Remember, it's 19% up to a limit of what? Up to a constraint of 15%. We're still at 19%. So times, open the brackets, 1 plus, so we're at 19%, and so we go to 17%. So 17% like that, and we close the brackets like that. We enter 160. 2026, we do the same like that, times, open the brackets, 1 plus 15%. 15%. That, we enter, and here we still enter the same value you can see, plus that value, times, open the brackets, 1 plus 15%. 15%, close the brackets, we enter like that. That is what we get for the revenue. Remember, we still have to go through the pessimistic case and the optimistic case, but we move systematically. We finish off the base case extract. So what does it say for gross profit margin? You can see here, I've highlighted it in this peach color almost. Gross profit margin for the first year of the forecast is the 3-year average for the period from year 2020 to 2022. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 50%. So the first thing is to first of all understand what gross profit margin is. So gross profit margin, allow me to use caps, GPM is equals to, we write the formula right over here. So we come to insert next to home, then we put the equation there, fraction, come to this one here like that. Then we just drag this fraction right over here and say the gross profit margin is given as the gross profit divided by the sales. That's what you get as the gross profit margin. So if you'll allow me, we could be able to compute the gross profit margin from the years 2020 through to 2022. So I will do it right over here because it corresponds with 2020 to 2022 right over here. Copy, just put that down over there, like that, the years. And you are saying that the gross profit margin is gross profit over the sales over here. So since we don't have the gross profit, we can be able to, we actually have the gross profit. This gross profit over here, we have it over here. I can highlight these gross profits over here. And the sales, and these are the gross profits over there. So those two are what we need to get. So for year 2020, like that, plus gross profit, that value, we divide by the sales, because we're just following this formula, that value. What is the gross profit margin for 2020? 0.5. But we want it as a percentage. So we click percent there, 50%. We drag the formula moving towards the right, and we can see that the gross profit margin for the 3 years 50, 60%, and 60%. As per the statement right over here, the 3-year average for the period from year 2020 to 2022. So that is what is going to be. So we need to get the average of this. So we click right over here, plus average. You can see it's actually given to you right here, average. So you click that, average of what? Average of the gross profit margins over there. And we close the bracket like that, and we do what? We press enter. Gives us 57%. So let's try and see whether the statement has actually been solved. So we say gross profit margin for the first year of forecast is the 3-year average from period 2020 to 2022. So we've picked the gross profits for 2020 to 2022. This is expected to reduce by 2% annually until the last year forecast, subject to a minimum of 50%. So the gross profit margin is the 3-year forecast. So we can, so that means the gross profit margin from the forecast of 2023 will be 57%. So we can put here 2023 will be 57%. So how do we get now the gross profit? You can see from the formula, we just multiply the gross profit, rather the sales down here, with the gross profit margin, which we've computed over here like that. So to get the gross profit, we get plus 57% times the sales, Enter. 65,516. What are we told then? We expect this gross profit margin is expected to reduce, you can see here, to reduce by 2% annually until the last year forecast, subject to a minimum of 50%. So 2%. So ladies and gentlemen, for consistency purposes, we just try and ensure that the format is the same up to 2027 right there. So, and then we drag what? We drag the years as well towards the right. So dragging would be able to, now of course, because we've just dragged from 2023, it will just replicate the cells from 2023. But we come right over here and fill the series, it now changes it to 2027. So what are we saying? We are saying that now we want to estimate the gross profit, the gross profit margins. So this one is reducing, plus that minus 2%, like that, 55%. Then we come over here plus the previous value minus 2%, shift percent, pardon me, like that, like that. And we are trying to ensure, because it doesn't have 2 decimal places, these others. So what we do is that I try and reduce the decimal places over here that we have. So first of all, I double click over here because the cell did not pick in 2 decimal places. I highlight format painter like that, and then I format it like that. It will come to 2 decimal places over there. No decimal place, sorry. So from there, I now move on to 2026. The limiting factor is 50%. So it's reducing by 2% throughout until it reaches 50%. So this one, so plus that minus 2%, like that. We have 51% like that. And this one obviously will have to be 50% because that is what the limiting factor is. And comfortably you can put 50% like that. So then, now that we have the gross profit margins over here, just like the way I had computed the gross profit is the sales times GPM. GPM is gross profit margin. So I can then comfortably come and drag my formula moving towards the right like that. Then what do? How do we get the cost of sales? The cost of sales is just this value minus that value there. So plus that value minus that value, we get 50. And remember, this value over here should be negative just for consistency, to be negative like that. So what we can do, we can put a negative over there, that, and it changes the value there, and do that. So we just put a negative right there, and it also changes, pardon me for that. So what we do is that we just pick negative. We can say that this value is going to be our negative value over here. So in brackets over here, we put it like so, like so. Then we put negative, delete negative, it comes like that. So consistency as well, that you just put it like that. So we proceed then. You can be able just to drag the formula like that. Once you get the plus sign like that, you can see it's go to the plus sign, you just drag it, it will just come and fit in like that. But I can see that if we get to just come in and double check over here, we can check and see maybe even right over here, plus that value plus that one gives us what? 65. So moving it on towards the right like that, we should be able to get the same values over here. So to just counter check, you just get plus that minus that value. If you get a 0, it's okay. So you can see you're getting negative, you're getting nil all through like that. You're actually just checking whether this value is the same as that value over there like that. So we just delete or do away with this part over here. Delete. So we'll come and now use the formats. You can see there's a different format over here and there's no borders over here like that. That was just something that we can be able to do as we finish off the base case. What are we being informed about the operating expenses? We go back now to the required part number 3, to the adjustments number 3. Highlight it as usual, put it up a bit. Operating expense ratio are modeled as the 3-year averages for the period from 2020 to 2022. These are assumed to remain constant over the forecast period. So what is the expense ratio? So the expense ratio relates to the sales. So operating expenses, expense ratio. So these workings over here are gross profit margin. Now here is expense ratio working, expense ratio. Like that. So expenses over sales. So that is that equation, expenses over sales, or operating expenses over sales. So you can just take this, put it over here, just pick the expenses, then you divide by the sales. pardon me, put it the wrong place, just down the denominator, down here, sales, that. So we're going to use this same period over here like that, sorry, copy, Control V, pick the years, then we put the expense ratio for 2020. So for 2020, we put the operating expenses. And just to counter check whether we're doing it from 2020 or from 2019, we've been told operating expense ratio are modeled as 3 averages for the period 2020 to 2022. So we are 2020 to 2022 like that. So plus operating expenses, that divided by the sales over this. I've picked 2019. You can see clearly it's 2019. So to do, just change that. It's very easy to change it. You just wait for the cross sign to change like that, drag it there. So 2020, it's that value divided by the corresponding sales of that one over there like that. But now, because it's negative, we put brackets so you can be able to get a positive expense ratio. You put it like that, then you put a negative and before that, so that you can be able to get a positive. But we're saying it's a percentage. So we press Alt H over here, and we're saying we want percentage P. We press P like that, you get 16% like that. And we're saying we can be able to drag that up to 2022 expense ratio. So what is the average? Just the same way we did over here for GPM, gross profit margin. We come to the formula bar, we pick average of which period for that value over there like that. So what do we say? We just pick average. You can see that. Which average are we looking for? The average over here. That, and close the bracket like that, and we say enter. You can see that that's the average there. So to just check through whether we are actually doing the correct thing, check the question again or the adjustment. Operating expense ratio is modeled as a 3 averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what do we do then? The expense ratio will remain constant all through like that. So we just drag that over here to remain constant at 19% like that. Oops, this should mean because it picks the formula, it picks the averages over there, so it cannot be able to do like that. So we just put 19% all through 19, 19, 19, and 19, because we all know that it is constant like that. So once we've done that, how do we then adjust these operating expenses? So you can see it's just the expense ratio times the sales. The expense ratio for 2023 is just that times the sales, the corresponding sales. So we just pick it like that. So plus the sales value multiplied by the expense ratio for 2023, like that. We get the value there. Remember, it's negative, so what do we do? Because the formula is there, we put negative, or then we'll just pick over there. So we put brackets, open and close brackets, like that, and we put before that, we delete and put a negative like that. You see it's okay. So for consistency, to ensure that everything is consistent, we just drag it like that, it remains like that. So what do we do then to populate this one over here? You can guess it, just like the way I've already done it. I've just dragged the formula like that. To counter check, does it pick the sales times the gross profit margin? Let's double check. So double click, you're picking the blue one, always begins, times the GPM, which rather the operating expense ratio, or the expense ratio, 19%. Then you escape. Just see that you've actually counter-checked there. Operating profit, we know it is just given as the gross profit less the operating expenses. So we pick like that, plus, because there's a negative sign over here, plus that, plus, because we do not need to minus again. It will do minus, it will give you a different value. That one, we get it like that. Then we drag, because it's a formula there, we just drag it like that. So what adjustment do we have as far as depreciation is concerned? We can now check our note over here. Note number 4, you can see here. I highlight it for you. Depreciation to revenue ratio is assumed to remain constant as a 3-year average for the period 2020 to 2022. We do the same. Depreciation ratio. That. So we just come over here to insert the equation. There. It's a fraction. Come here and say that the depreciation ratio is just depreciation divided by the sales. Sales. Like that. And if we have that, we just pick these values here with your permission. Copy, and we just paste it down over here. Control V. Depreciation ratio, for us to get the depreciation, we need to first of all, depreciation ratio from 2020, we just get depreciation divided by the sales. Plus, where is our depreciation for 2020? Depreciation is here for 2020, not 2019, like the way I had almost done previously. So you need to be very careful. That one over the sales, that value. And because it is going to give us a negative answer, we just preempt and put it in brackets like that. And you put delete minus. So plus minus for the formula is equals to that. We get a positive value. This has to be in percentage form. So again, Alt H P. So we increase it to see the percentage like that. So if that is the depreciation ratio, you can see it is L15 depreciation divided by the sales. That should be dragged now, moving across up to 2022, please, not up to 2027. What have we been told from 2023 to 2027? Depreciation to revenue ratio is assumed to remain constant for the 3-year average 2020 to 2022. So it's the average. So it's going to be 0.9%. So you just copy that value, paste, Control V. Undo that. Then you Control paste special values, because it will pick the formula right over here. Values. Okay, like that. So the thing that I didn't highlight all of it over there, so we just undo again. We are copying this, copy, and we want to paste it over here. Paste special. We do not want all, because we'll copy the formulas as well, so we want the values. Okay, but now because they're not in percentage form, we just click that. It will give us a percentage form as it is, like that, 0.9%. How do we get the depreciation from 2023 to 2027? Depreciation, which is the numerator, is just the sales times the depreciation ratio. So we just come over here. Is equals to minus, because it's going to give us a negative value, sales times depreciation ratio, 2023, that. And we close the bracket. Enter. Let's move back up and see whether it's given us that value. Yes. So we're picking that value. Format Painter, we move towards the right like that, and it will just pick. Then what do we do? To populate this part, we drag, because the formula is going to be consistent. It's just going to pick. To double check, that as the sales times that depreciation ratio. We proceed on, escape. But here, profit before interest and tax should be a formula. just like it's over here it's not picked the formula because we just copied it from the exam worksheet. If you pick plus that, it will give us that answer 1200. Recall it was the same. So if I want to see if it was the same, I just undo. You come over here, undo. You can see it doesn't have a formula, 1200, but when I redo, it now has a formula like that. So accountants, I'm supposed to ensure consistency all through. So what do? I just drag that like that. And you can see what it gives us. How about finance costs, guys? Finance costs, let's look at what we're informed. Finance costs, I highlight. Finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate in year 2022 over the forecast. So how much it has reduced from the finance cost right over here, you see from the previous year it was 9,000, it has reduced to 8,000 like that. So we are saying we are being informed that we use the reduction rate. So reduction rate like that. So we pick the one for year 2022. So I'm going to come over here and work it out over here like that. So the reduction rate is plus that plus the previous year. It shouldn't be. Did I pick the correct value? So plus this one minus that one. Yes, minus, not plus. So it's 1,000. You can even clearly see it's reducing by, from here, it has gone down to that. So the reduction rate should be 1,000 throughout like that. So how do we apply it? Plus, now it's going to be, we just drag these values until 2027, sorry, up to there. But you can see because of the format like that, so it's going to be copy. If you see it does like that, you copy, then you paste it like that. Control V. If it refuses again, guys, because this one has got a formula, you copy like that, you paste special. Remember what we did just before? Paste special. You're only interested in the values, not the formula. Values. It will pick. So what we're going to do is that we're going to pick, this one is going to be reducing by 1,000. So plus this one plus 1,000, 7,000, and we drag that all through. There is no constraint in as far as finance cost is concerned. You can see there is no constraint. Use the reduction rate in year 2022 over the forecast period. So 2022 it has reduced by 1,000 and that's it. Format, painter, like that. Profit before tax, we get plus that plus, because it's minus, you can see this minus all through. That's that, like that. So even this profit after tax, before tax, sorry, plus that should give us that value there, and we just drag the formula across, moving like that. Income tax expense, let's see what we are being informed. The final part. Income tax expense is calculated as the historical effective tax rate. Where did we calculate the historical effective tax rate? In part A of question 21. Where is part A? In the first tab just down here below, you can see it right down here. Yes. So we click there. What is the historical tax rate there? You can see it's 30%. So all this will be able to continue until 2027. So we come back to tab 21B. We can just come over here and have a working here, small working, tax rate. So finance cost, you can see right here, income tax expense, let me highlight it, is calculated as historical effective tax rate. So from 2020 to 2022, is 30%, Control V like that. But we need now, of course, continuously until 2027. Simply saying it's just going to be 30%. How do we get the 30%? Just to remind ourselves how we got the 30%. The tax rate was plus the income tax expense. I'm on 2020, yes, 2020. Income tax expense for year 2020, you can see 2020. That divided by the profit before tax. That. But because it's negative, we are saying we need to put a negative sign just before equals. Then we delete that one, delete, and then put a negative sign like that and open the brackets like that. Okay, it's decimal, but we put it percentage. Alt H P. But we need the format to be the same throughout. 2027, right there. So we can be able just to drag it to be the same. It should be the same up to 2022. But we cannot drag it over here because there's nothing we have put for the tax rate, income tax expense over here. So we copy this. Copy and paste special. The rate is what you're interested in. Paste special. Should we go to formats? No, we go to values, guys. 30%. So how then do we get the tax rate? Like that. So we can just get, it was this value over that value there. So we don't have the income tax expense. We're saying we're going to charge 30% of this. So plus, right here, plus, or rather is equals to minus, because we want it into a minus sign, open the brackets, that times this value here, down here, 30%. Close the bracket. We should be able to have negative sign there. So we drag it. Wait for it to have the plus sign. Sorry, just as, yeah, like that. Just drag it. Formatting should be the same. Come to Format Painter, you can see. Come there. That. Here, there should be a formula. Plus that one, plus that. Should have that. We drag the formulas going across like that. And that should give us the estimate for the base case. The rest now, guys, we can be able to now just put in the same formats. So what we can do, we can just highlight that. You see Format Painter like that. Simply just put it like that. It will pick like that. That is for the base case. We can be able to move on towards the right of the screen. I'd initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here.
Welcome to Manifested Publishers.